We know that you can kill inflation if you raise interest rates high enough. Paul Volcker did it. He killed inflation, but it was at 21% interest rates. I still remember my first mortgage. I bought a condo in New York City. The mortgage was 13%, but inflation at the time was 15%. So my real cost of borrowing was -2 before tax benefits. It was more like -7 after tax benefits. So it was actually quite a good deal at 13%. But that happened. But that was part of how Paul Volcker beat inflation in the early 80s. So you can do it. But from current levels, which are over 8% in the United States, but even Japan's up around 2 or 3% again, which is sky high for Japan. Japan's a country that's been in. We used to talk in the early 2000s about the lost decade. Well, now we're entering our fourth lost decade. They've had 30 years of very little growth, and I checked it out the other day. Since the market crash at the end of 1989, and it was a multiple market crash, it was stocks, real estate, commercial real estate in particular, and other asset classes at the very end of it, 1989 into 1990. That was ago. Since then, Japan has had 8 recessions in 32 years. So in other words, the expansions were not that great. So they've just been kind of churning, going sideways that whole time, but with a lot of deflation along the way, to the point that younger Japanese think of deflation as normal. Okay, things get cheaper. May not make a lot more money, but things go down. Well, so 2% is a shock in Japan, but it's over 8% in the United States. It's getting close to 8% in Germany, throughout Europe. And of course, the Germans, I did an interview for our German audience this morning, and they still remember 1923. Now, there's nobody alive with a living memory of 1923, but the cultural memory, the continuity of that extreme anti-inflationary bias and fear of inflation has never left the German people. So again, that's a shock there. So the inflation's real. The question is, how high do interest rates have to be to squash 8% inflation? Well, the answer is 10%. And the reason I say that is because you need a positive real rate of 2% or more. So the real rate is just the nominal rates. That's the rate you see on TV or on your screens or your ticker or whatever it is. That's the nominal rate. You have to subtract inflation to get to a real rate. So when nominal rates are, right now they're about 1.25% on Fed funds, not quite 3%, about 2.7% on 10-year Treasury notes, et cetera. That's the nominal rate. Well, with inflation of 8%, so just use round numbers, if you have 2% interest rates and 8% inflation, your real interest rate is -6. Great time to borrow, great time for borrowers, because you get to pay it back in cheaper dollars. So you need not just higher rates, but positive real rates. So with inflation at 8, you got to get real rates to 10. So now your math, I always say you don't need calculus. Calculus is fine, but it's 5th grade math. 10 minus 8 is +2. So that's a real rate of +2. Well, who thinks that the Federal Reserve can get interest rates to 10% without causing a recession, without causing a market crash? I'm not talking about a bear market. I'm talking about absolutely tanking the tech sector, the banking sector, and a lot of other sectors besides. Well, no one thinks that. They know what the consequences would be. So then if you're the Fed, well, how do you escape the room, as we say? Well, there are 2 ways. You can kind of raise them very gradually and hope that inflation comes down gradually, and you kind of meet halfway. So you get interest rates up to maybe 2 or 3%, and inflation comes down from 8 to 7 to 6 to 5. That's a lot. That's still a negative interest rate. If inflation is 5 and interest rates are 3, you still have a -2 interest rate. So inflation will only come down when rates get high enough, but rates cannot get high enough without causing recession. So, and Larry Summers has done a good job of pointing this out empirically. It's one thing to state it as a proposition, and it's a valid proposition. It makes a lot of sense. But he looked at the data and he said there has never been a case where unemployment was this low, inflation was this high, and the Fed raised rates without causing recession. It's never happened. So a so-called hard landing. So So with all that's true, and it is true empirically, historically, and analytically, all you have to do is look ahead and say, well, okay, we're going to have recession. Stocks are going to come down a lot more. Get out of stocks. You don't have to get out 100%, but get out of stocks, move into cash, move into other asset classes that'll perform well, and ride out the storm. The European Union, the UK, and the US, and I have to admit, I'm a little surprised that the EU kind of tags along with the US. Okay, that's easy. But the UK has been more aggressive than the US in terms of rhetoric, supplying weapons, imposing sanctions, etc. I'm not sure. Boris Johnson had a near death case of COVID in 2020. It was nice to see him recover, but I'm not sure that he's fully recovered, at least as a politician, because he just behavior is a little bit hard to explain. But the UK has been, as I say, more aggressive. But that said, the sanctions are failing. It's very easy to explain why. We can go into that, but they are a kind of a two-pronged bet. One bet is that you can put enough economic pressure on Russia that they will see it in their interest to either leave Ukraine or reach some settlement that requires their withdrawal. That's not going to happen. I've spent time in Russia, friends in Russia. I've studied it closely for a long period of time. The Russians have an ability to endure hardship, endure pain. I call it, just pass the vodka. That's kind of their attitude. I mean, this is a nation that fended off Napoleon and Hitler at great cost, of course. I'm not minimizing the human tragedy of it, but they did prevail against Napoleon and Hitler, two of the greatest, kind of megalomaniacal conquerors of all time. So I can't imagine they're very intimidated by Joe Biden or Boris Johnson. Hardship, yeah. Some inflation, yes. Slower economic growth, yes. But enough to get them to pivot on Ukraine, no. So it's a bad bet by the West to think they can change Russian behavior, number one. Number two, let's just take the sanctions one by one. And I'm enough of a geek that I've actually read hundreds of pages of Federal Register releases and White House releases. And I'm an expert on sanctions anyway. I did that for many years, worked in that area for the national security community and the intelligence community. So one of the sets of sanctions is they've named these oligarchs and we've made them fair game. So you can confiscate their assets, freeze their bank accounts, seize their yachts, seize their houses, their townhouses in Belgravia, put maybe a few in Australia. The Chinese like Vancouver and the Russians seem to like London for various reasons. But seize those properties, put them up for sale, and use the money to rebuild Ukraine, as the case may be. And that's really going to show the Russians. Well, what they don't understand, this guy Wally Adeyemo, who's the Deputy Secretary of the Treasury, he's the point. Janet Yellen definitely does not understand anything we're talking about.